welcome to my channel. It is a great pleasure to have again Ted Oakley, founder of Oxbow Advisors, and somebody that you have to follow because he always has something interesting to say about what's happening in the economy and the markets. How are you, Ted?
I'm doing great, Daniel. Thanks for having me.
Thank you very much. You can follow Oxbow Advisors in the references that we will give you in the details of the video below. Ted, I would like to start by getting a bit of an overview from your side of how do you see the economy, and then we can look more in detail at markets and your outlook for markets.
Well, I'd say, Daniel, on the economy, I guess what we're looking at is that we don't think it will be as strong as a lot of people think. We're feeling like that to a degree. The supply chain situation is improving. I don't think people are noticing it, but it's improving. And we think that a lot of that catch up will come along, and all of a sudden, you'll be in a position to where the growth numbers won't be what people expect. For obviously, in the first quarter, it's going to be softer because COVID has run people back inside their homes. Not that they're all really deathly sick, but it still caused them to not do things. So what we're looking for is really an unusual year. We think this year will have a couple of periods that will be more volatile than people are used to the last year and a half. And when they get that, not necessarily they'll know exactly what to do with it, but we could see a couple of times this year where volatility comes in. You get hits in the marketplace, and then you have a recovery, and it'll be interesting to see how the average investor takes that. But that's the way we look at the macro part of it right now.
Mm-hmm. So, when you look at softening of the economy, what is your perception about inflation? What's your take on how we will see inflation playing out throughout 2022?
Well, we have, Dana, we have a piece coming out tomorrow, and we show about 8 or 10 commodities. And while they really were strong all during 21, they've either leveled off or they're starting down. Now, it's a little confusing because in the CRB index, you'll see it go to a new high. But if you look underneath at like 15 or 20 of the commodities, they're either flat or they've rolled over a bit. That does not mean you won't have inflation, but for us, it means that that level of inflation would not be what we experienced last year. Last year, maybe 6.5 to 7 or higher. And it's a little hard to know exactly because of the way they keep reconfiguring the CPI, but we think that you'll have it, but it won't be what people probably expect. We're seeing a lot of people expecting sort of runaway. And while we think you'll have it, but it wouldn't be what you experienced in 21.
Mm-hmm. Do you see that there's an improvement in the supply chains in general, supporting this view of a more moderate but still elevated level of inflation?
Well, we see it at the ports primarily, and we have an office on one of the ports, but we also see it in the West Coast ports in different places. It's not back like it was, but it's probably 40 or 50% better than it was, this time last year. And I think people have a tendency to just judge things from the most negative, or what it was 2 years ago, but you have to look and see, is there any improvement at all? And we do see that improving a bit. Now, it may not get back to normal at all, but at least it's better than it was. And I think what would happen is that you'll get a situation where all of a sudden people will realize that, hey, I can get that product now, maybe not quite as bad as last year. And so things change like that. We'll have to see, but that's what it looks like to us.
Uh-huh. And so when you look at the Fed's announcement and especially about rate hikes and the pace of normalization of monetary policy, how likely is it, in your view, that they will follow that path, accelerate it, or just as they tend to do sometimes, fall back on some of those expectations?
Well, I would say, Dan, I would say that's the biggest investment question of 2022. That one thing that you just mentioned, will they really do it?
Yeah.
And we ran a graph yesterday showing the Fed funds rate going back to '09, and that one little blip in the fourth quarter of 18, and they turned on a dime and they moved really quickly to go the other way. And so our question to that is, will they really have the fortitude to do that?
Yeah.
And we haven't seen them so far, unless something's changed the last 2 weeks. We haven't seen them back off a lot, even on the purchases, not near what they were going to do. So we'll have to see. But if they back off the purchases like they say they're going to, and we see that they'll raise rates maybe once or twice, and we do think they're raising rates into somewhat of a flattish to not a robust economy. So we think they're behind the eight ball. But the big question will be whether they do it or not. And my guess, they would do it and then fall back, because as you know, and I know you've mentioned this, your books talk a lot about these things, but if you look at what's going on in financial engineering, since they started this whole thing, it's all about the market. They can't stand for the market to go down. It'll be interesting to see if what I have to say, have the guts to really do that, and we'll find out, I suppose.
Yes, it's certainly true that they change the pace immediately uh, when there's a correction, and I think that that's the way that the market seems to be positioned. I don't know if you see it that way as well. That the market, on the one hand, is probably not taking a higher level of risk into the more cyclical part of the stock market, but at the same time wants to keep exposure to risk because of the experience from 2018 and the previous so-called years of normalization. Don't you think that that is where more or less investors are?
I think so. I mean, what we look at, is the complacency level is still really high.
Yeah.
We don't find anybody worried about anything. I think they think, well, if that happens, they'll have the plunge protection team in there again, working on it. I'm not certain this time they'll be able to control it, because what can you do if you have administrative pressure on you to say, we got to get this inflation thing in check because our numbers are really falling? On the one hand, on the second hand, you say, well, I can't loosen the money because that causes the other to be a problem. And, it's a catch-22.
It is a really difficult choice for the Federal Reserve. On the one hand, you have a government that is announcing very high levels of deficit spending. 2021 was the second highest deficit in history, and 2022 is likely to be one of the highest as well. So obviously, on the one hand, you have a government that is deficit spending and binge spending massively. On the other hand, they have to look for ways to control inflation. So they, between one and the other, and a market that seems very complacent, in my opinion, they tend to err on the latter side, which is to think more about the market remaining relatively calm rather than pursuing rate hikes that can change dramatically the inflation path, particularly when, as you have just mentioned, there are some measures of inflation that are going to be sort of helping in the way in which they calculate it, helping reduce the pace of price growth. But I'm interested about where do you think that investors should be looking at apart from the rate hikes? What are you telling your clients these days about what you like and and how to position themselves, and to at least throughout the period in which we see whether all of this ends up playing out the way that the Fed has mentioned?
Well, our biggest theme, really, if you want to get to it, is balance. We only have three strategies. We have a really conservative strategy that's basically bulletproof, and we have a very high income, aggressive income strategy, and then we have a growth strategy, stocks. But everything we do ties to cash flow.
Yeah.
And one of my big problems with crypto and that sort of thing is, if you look at all great investments over time, they tie to cash flow. Private businesses, stocks, bonds, oil and gas, real estate, everything ties to cash flow. And we see so many people now invested in things that have no cash flow, okay? And we're like, well, that's okay when you're really speculating and things are on fire. But when you go through tougher times, we think it'll revert back to that. So from our standpoint, what we look for On the stock side, we're looking for companies that have high cash flow, that don't have a lot of debt,
Yeah.
and we think can still make pretty good money over the next 5 years, no matter what. And secondly, in the high income strategy, we look for a lot of different things. You'll see where in both the high income and the conservative strategy, we have about 4 or 5% gold. We have that hedged out. And then we have a situation where a lot of the things we own are highly diversified, from medical real estate investment trusts to oil and gas pipelines to really high quality preferreds, a lot of things that produce a lot of great cash flow. And we'll hopefully all of this will get us through no matter what. And we probably have all in about 30% liquid right now, because we can't really find that many things that fit that criteria for us. So that's where we are at this point.
It makes sense, no? Because in an environment in which 2021 was almost like the perfect year in terms of risky assets. You had, on the one hand, the reopening, which generated very aggressive bounce figures. On the other hand, you had a massive fiscal stimulus. And finally, you had a huge monetary stimulus. But none of those three are working in order to generate multiple expansion as they did in 2021. So it makes sense to look at cash flow and companies that are actually generating decent levels of margins and are able to escape the pressures of inflation. One thing that you mentioned is the difficulty to find value in this environment, because obviously those as well have risen dramatically and done phenomenally well throughout the last 3 years. Do you think that when the correction in no earnings assets is very obvious. It's very logical. There's nothing that can allow an investor to discern whether there's value or not, because they're not making any money whatsoever. But where do you think that in an environment in which the Fed maintains a certain level of rate hikes, even if they're not as many as have been announced, and inflation remains relatively elevated, wouldn't you think that multiples will likely continue to be significantly high for those companies that generate strong cash flows and good earnings?
I think so, Daniel. I think what will happen is, this idea, and you mentioned it there, of investments that don't make any money or any cash flow. And if you look at it, it's stocks and SPACs and crypto and all that. And what those are, they're basically, you have to find somebody that'll pay you more than you pay for it. That's it. There's no cash flow. There's nothing. But on this side of it, answer your question, yes, I think that's true. I think even those companies correct a little bit if you have a correction. But if you have some liquidity, you can take advantage of it. And we always say a sell-off does is not necessarily so negative. People say you're negative. I say, well, not necessarily. If we get selling and we can buy things cheaper, we have cash to do that with. And so that works for us. But to answer your question, yes, I think those companies will stand out, because there will come a time, and you remember this too, back in 98, 99, all of those companies that didn't make any money went away.
Yeah.
They're not even here anymore. I could give you a list of 25 of them, and all the names associated with it and that sort of thing. But we think those companies will still stand out. Yeah, they're the companies that usually make it through the tough markets to get to the other side. But the ones that don't make any money and never made any money, I sell at 10 times revenue, we can't see any way they make it to the other side.
Yeah, that's I think one of the big lessons of the tech bubble that people seem to have forgotten, is that you've said one very important thing. It's not that they go down; is that they disappear. Hmm? And we forget. I tend to show I always show to my students a report a month before Enron collapsed, saying still the best of the best. Huh? So be careful.
Well, I know who wrote that report, by the way.
Oh, yeah.
It starts with a G, and I have a copy of that myself, as a matter of fact.
It's one that it's always good to have it in order to remind ourselves that elevated valuations and broker recommendations are not necessarily something that you have to follow because of momentum. And coming back to momentum, Um, in an environment of slowing down of the global economy, which I think that is even becoming part of the consensus, or at least some of the international bodies are starting to include it in their estimates. In an environment of slowing down of growth, the where in the energy and in the infrastructure landscape, etc., do you think that there is a higher level of support? Do you see that is that there are different pockets between all those commodities that you follow?
I do. I do think the energy. I think the energy EV, conundrum is going to be longer than people expect. I can't imagine that they think we're going to go from 100 years of fossil fuel to in 7 or 8 years get rid of it. Just doesn't work that way. So what happens for us is we look at the things we know will provide some cash flow. It goes something like this. If you look at what we own, for example, and we've owned for some time, we bought them cheap. But if you look at Chevron and a company called Brigham Minerals, and if you look at on the pipeline side, if you look at Enterprise Products and Marathon, those kinds of things, we know we'll pay the cash flow. And that's what we want, because let's say that we own something that's a 8% cash flow and it goes to 10% cash flow because the price goes down. That's where, as an investor, you have to have the ability to know that, you know what, this is something I need to add to. And that's really where you pick up steam in terms of when you come back on the other side. And that's what we look for in the energy sector right there, what you're speaking about. They've run it up and down the last 4 or 5 months, and we've taken advantage of that. But we're probably a tad bit lighter than we were 3 or 4 months ago. But we haven't left that sector at all. And we see a lot of great cash flow there over the next 5 years.
When you look at the energy sector, also there's such a level of underexposure from the market in general that additionally, just to get to equal weight in the case of many institutional investors, requires a lot of buying anyhow. Huh? And it's been years of underinvesting that have led to the current situation of supply and demand in natural gas and oil as well. So I think that the services sector looks also quite interesting. What is your opinion about the services sector?
Well, the services sector comes in late
Yeah.
typically. It's not that they don't do well. They do, and they come in late. One of the things that happened with the service sector is they got under so much pressure to lower day rates, day prices, things that they did, their services, is that it's been slower for them to come back
Yeah. Yeah.
because there are a lot of people going after the same product. In other words, we'd slowed down production. And so a lot of people were going after the same thing. And so they were price competition. However, when you get to the end, higher over the next 3 or 4 or 5 years, and you get a slowing, and you keep getting a slowing in production and finding oil and gas, you'll find that they will probably come in and do fairly well themselves. They're a little bit different in that they don't trade so much on the commodities as they do their earnings per se, but they get there eventually.
Yeah. Also, also as the market starts to see capital expenditure coming back, doesn't it? No?
Right.
When you look at the at sectors that are right now seen as the preferred option to play the recovery, financials and everything that is has to do with consumption, which part of these sectors do you find more inclined to invest in?
Well, on financials, I know they bounced, over the last couple of months because people started building in higher rates. And since I'm very familiar with the banking industry, being on a bank board and owning owning part of a bank myself, I know sort of the troubles they go through right now. And one of the problems right now for the finance sector, the banking sector in general, is that they have too much money chasing too few loans right now. And so they're keeping their rates down because you have to get real competitive on doing the rate thing. And so I think that will bother them for some time. And unless you get rates a lot higher than they are now. And by that, I mean, you're going to have a move in the prime. That you think about all these things are going on with the prime's still the same.
Yeah.
And so I think until that changes, you probably won't see any significant, I think the banks have sort of had their run in here. We wouldn't be a buyer of them right here. We do by the way, we do on the convertible preferreds of the banks because we get the best of both worlds. But
Yeah.
that's a little different animal. But far as that goes like that. Now on the consumer side, I do think that we will look for basically consumer non-durables during a period. If we think we're going to go into a period in the second or third quarter where it's maybe weaker than people expect, you'll find us looking at more of that type of stock.
Mm-hmm. So, and when you were mentioning about the financial sector, one of the things that we're starting to see with the recovery is the rising non-performing loans on the one hand, and the other one is that at the same time, the strength of the balance sheet of many of these financial institutions is strong, so it's pretty high. So therefore, you mentioned a very interesting thought, which is that, and we tend to say this as well to our clients, which is instead of looking at the shares, look at the hybrid products that they're issuing because they're very attractive and they give you the best of both worlds. You get an income, and at the same time, you participate in the strengthening of the balance sheet of those financial entities. So I tend to find as well that it's cheaper to look at those hybrids than to look at the ordinary shares. In consumer, one of the things that I've been reading recently from a few brokers is that the main concern coming into a period of prolonged inflation is likely to be that we see stretched margins in some of the consumer, particularly in staples. No, what is your thought there?
Well, I think people have bought everything. And one of the things about since we have the index funds and exchange traded funds is they extend everything. Okay. So we really don't have this market anymore that, there's ambivalence in the market because they buy everything in the lot. But on your subject, yes, I think those margins are extended. If you're going to buy those kinds of companies, you have to buy them right. You have to buy them. We used to look at companies and some company we want to own that would be in that category, and it would stay expensive all the time, and we'd finally get a chance in a big market sell-off to buy some of it. But yeah, I think those margins will come under some pressure, not only because maybe of the purchasing side, but also because they're having to pay more,
Hmm.
for everything, for
Yeah.
wages, for supply, everything goes into that product. So that could very well be a problem for them. We do not own many of those kinds of things. We own more of the kinds of things that would be a Visa, a MasterCard, things where we know there's going to be transactions going on no matter whether economy is good or bad, and that kind of thing. We look for the O'Reilly Automotive. We look for things that we feel like you have to have. I mean, we find very little downturn, for example, in that business. And so that's the kind of thing we look for.
Hmm. So companies that work and have historically proven to be working in an environment of a slowdown, which with proven track record of high margins. No,
Right.
when you look at the composition of a portfolio, you mentioned before that you own like 4 or 5% exposure to gold. You have a little bit of exposure to gold. Tell us a little bit about that. Why do you see that? Because many people say, well, gold is not working as a hedge to inflation. I always say to people, gold is not a hedge to inflation; it's a hedge to crashes or to corrections. What is your thought about keeping a little bit of gold in the portfolio?
Well, Daniel, we think gold is a hedge to problems,
Exactly.
sort of like
That's
you
that's a
mentioned.
great word.
And
I'm going to use that as the.
and so what happens is, and we do it I'll tell you how we do it two ways. We own half of our gold position is gold,
Yeah.
and the other half are a couple of miners.
Oh,
We own Franco-Nevada, because we really want to be on the royalty side. We love the way he ran that company and ran that whole thing, Wasan. We also own Newmont, but because of the dividend, 4% dividend. I mean, who would have thought a gold stock with a 4% dividend minor? So we have a split on that. And what we think will happen is this, and that is we think that there's some period, I don't know if it's this year or the next 2 or 3 years, we will go through some period where there will be some high degree of uncertainty
Yeah.
in everything. And when that happens, because we're up against this debt level, we're up against this speculative level, somewhere along the way, things get really uncertain when it breaks down. And that's when we feel like gold will really shine, pardon the pun. But I think at that point in time, is where you'll see gold really come around. Now, if you look at it, it's what, 1795 or so today. It's, been down 1750 up to 1820. And you've got people on both sides that are saying, hey, it's over. And one side saying, hey, we're going to 3,000. We just feel like in general, and by the way, if you look at a gold chart from 2000 and a Berkshire Hathaway chart, even money, they both made the same amount.
Yeah.
And people don't realize that. They well, gold, what's gold? Well, it's done pretty well the last 21 years. So I think they have to keep that in mind.
Yeah, that's something that people tend to forget in periods of high exuberance and in periods in which everybody is trying to find the next thing that will rise 20%. Is that 1795 uh, is reserve of value, and in terms of performance throughout the last 20 years, it's up there with some of the best things that many people have looked at. What is your view about technology and technology information? Is there anything out there that you like, or is something that you find less attractive?
Well, what we find with technology now are companies that are producing some sort of technology that you can translate into revenue
Yeah.
for your company. So if I'm selling you a product, for example, Salesforce.com, that kind of thing. Okay, if I'm selling you a product, of the cloud companies, that sort of thing, that can make revenue for make your company better, make more revenue for you. Those are the kind of technologies that we want to look at. Those are the kinds of things that we think, well, um, if I can sell something to you that will actually create that, then that's going to be good for me and good for you. And I think that's where we concentrate that sort of thing. I see so many companies, Daniel, that are selling on what's going to happen next year or the next year or the next. They're not making any money now. They're burning cash. And for your listeners, I just looked back this last week, as a matter of fact, and I was reading, about pets.com. And I don't know if you remember, CMGI was $1.99 at the high, went to $6 in a year. And it was the darling. It was the new Google, so to speak. I could list all those people and all those companies, Mary Meeker, Quattrone, the Munder Net Fund, all those things, okay? But every single one of them was betting on the come.
Yeah.
We don't think that is a great investment idea, is to say, well, I want to find somebody that'll pay me more than what I've paid today, rather than depend on, okay, you know what? We can produce enough cash for the next 5 years that somebody's going to like what we own and they're going to buy it. And so that's what we look at.
One of the things that keeps people sort of focused on very aggressively valued stocks, or or high concept stocks, is the idea that no matter what, at some point, the central bank is going to sort of cushion you, or save you from a bad investment. What people tend to forget is that monetary policy works both ways. And that there's a point in which the diminishing returns of monetary policy just don't create any type of multiple expansion, no? And I think that is one of the problems with these types of concept stocks, is that you really rely on things that are completely out of your analysis and your control in order to maintain a position in some of those names. And in a slowdown, the expectation of earnings is moved forward another year. So they don't become cheaper; they become more expensive. So I think that that is one of the big risks for 2022. Which comes to my question, which is many people that have written to us say, "Hey, 1 second. If the returns of the S&P 500 have been dictated fundamentally by a number of technology stocks, and technology starts to fade out, what is going to keep the market relatively stable?" And probably your answer comes back to your earlier point, but I would like to know how do you see that playing out?
Well, I think what would happen is this type of thing. And if you look at the markets, they're really, I know you know this, Daniel, but they're really camouflaged today by these 6 or 8 stocks that are really running. And if you look at NASDAQ, for example, 50% of the stocks are off, or they're well down from their highs by quite a big number. And it's just a few stocks that are keeping this thing up. And what happens in these downturns, and this would be my concern for the last 13 years, that you have all these people in the industry that's never seen it, and that is when they go down, and you know this, they all go down. It doesn't make any difference how great you own. Or I can say fundamentally, this company fundamentally is just fantastic, but they all go down.
Yeah.
So what happens is those will go down as well, just with the others. But you have to be in a position where you have some balance. This is where we come from on it anyway. Right now, we think things are really expensive. Even the good ones are expensive.
Yeah.
I mean, they're up at valuations that are very, very at the upper end of everything. So what happens for us, we carry quite a bit of liquidity. And if we do get that type of thing where they shrink that whole thing, we have the ability really to own those and some other things. We look around typically um, and find things that are really, one of the best years we ever had was '09. And it was not because we're geniuses. It's just because we had a lot of cash in the first quarter. And we found things that were cash flowing. I'm talking about dividend cash flowing, well, over 15%. Well, I got to buy it in the long run. That's the kind of thing we look for. And that's how we would offset what you're talking about in a downtick.
One question. Do you have a particular view about currency, about how do you see the dollar? Do you think that 2022 is a year of ongoing dollar strength, considering what's happening with all of the other currencies? At the end of the day, it's a relative game, isn't it? Do you have a particular view about it?
Well, I would almost reverse it back to you because I've always thought that you were the greatest at worldwide look. I've obviously followed you a long time, and I think the views you have on a lot of things. And for us on the dollar, uh, you know, it, if if in fact it breaks down, and if you look at it, just sort of been up and down in here, and it's sort of sitting on a little level, and some people are saying we're going to break down, not break down. Um, Unless you have something that is really extraordinarily wrong here, I wouldn't look for terrible weakness in the dollar just now.
Yeah.
I think over the next, 5 to 7 years, you look at what's going on in China and Russia and places. I mean, obviously they're thinking differently because they've been buying all this gold.
Yeah.
But if you look at the dollar itself, I wouldn't say, answering your question, we do not factor it. That's not the biggest factor in what we do from investments, but it's something we look at because if you go through a period where it stays weak and weak and weak, you got to keep that in mind.
Yeah, absolutely. No, my point of view is that with the currency debasement that we're seeing all over the world, particularly on emerging markets, 2021 was an extraordinary year. It was a year in which, for the first time in many years, you saw commodities rising, but emerging market currencies going down relative to the dollar because of the massive imbalances, monetary imbalances that these countries have built. No, everybody talks about the Fed printing money. We forget of how much Argentina or Turkey prints money relative to their demand. No, so I think that that is likely to keep the dollar elevated in relative terms compared with the rest of its trading currencies, and also with the euro, because there's something that doesn't work at all for the Eurozone and for the euro as a currency, which is the combination of slowdown and persistent inflation. That is very, very negative for the Eurozone economy.
Well, it's certainly the old, as you know, as you studied, you're good at this, but the beggar thy neighbor policies of the 20s, and everybody is trying to race to the bottom.
Yeah.
And I think there's still a good bit of that, like you mentioned, that went on in 21. So, we'll have to see how to see it plays out. But I think you hit the nail on the head.
But that is likely to be one of the things that keeps valuations of hard assets and cash flow generating assets and revenue generating equities higher, is precisely that the only way in which many investors globally can find a way to sort of circumvent or to escape the inflationary pressures or debasement of the currency is with high quality revenue and cash flow generating assets. So that certainly underlines the importance of the investment process that you were mentioning before. Mm-hmm.
Well, that's true, and I think people now, and I would think you've been around a long time, and you probably agree that they discount the benefit of cash flow. They discount it. I mean, if somebody walked in here today and told us, "Hey, I'll guarantee you, lay down, you can get 6% for the next 5 years. I'll guarantee that 30% in 5 years," we'd probably take that.
You bet.
It's a good return.
Oh, absolutely, it is. Absolutely, it is. Particularly with the risk of increased volatility. I think that's another point that people tend to be forgetting, is that we have grown accustomed to such low levels of volatility and such lack of news flow in terms of real movements in markets, real movements in terms of volatility, that an increase in people tend to forget that the many investors, particularly small investors that have bought ETFs or that have bought at the peak of the market, their tolerance for volatility is much lower than what they perceive. And when there's a correction, that plays out very aggressively. So the return of volatility is one of the key themes that I think you outlined, and that is very important. No?
Well, I think you have so many investors around that, again, they've only been around the last 13 years. And so that was a March 09 bottom. And so they look at that, and we find that here's how we see it so much. I can't tell you, and I'm sure you hear the same things about individuals and kids in high school and college, and somebody, they're doing so-and-so over here, but they're making a lot of money over trading day to day, minute to minute, that kind of thing. And the last time we had that was 1999, I will tell you. We do obviously a lot of work all over the country, and we had a lot of places where people were saying, I'm day trading now, I just quit my job. And then we looked up 36 months later, and they were all going back to work. Yeah. And so, so I think there'll be a lot of that. And unfortunately, I hate to say this, but a lot of that will fall on the hands of the young, particularly under 40, because they just are living in a bit of a what I call a Pac-Man fantasy world. And I think that's where we are right now.
You bet. No, that's a big risk. That's a big risk. There's, in Mexico, people still remember the times when a young person would get a job, get their first check, quit the job, put it in the stock market, and live of that until it stopped. And when it stopped, oh my God, it hasn't recovered yet. It hasn't recovered yet, and we're in 2022. So look, it's been great to get a little bit of a view about what you see in markets. It's always very interesting, and I hope to be able to chat with you in a not too distant future. Thank you very much for your time, Ted. Always a great pleasure. Have a very happy New Year, and hope to talk to you soon.
Thank you, Daniel. Appreciate it.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.